Welcome to this episode of Into the Multiverse with Sphere, where we're going to talk about how you can adjust your investment portfolio as interest rates move down. So as a multi-asset investor, there are multiple asset classes that you're looking at, which means you need to think about how low interest rates affect your investments in bonds, stocks, and other asset classes, whether you're looking at commodities or even global investments. So let's take a quick look at how lower interest rates impact each of these asset classes and how you should be applying your framework to be making sensible multi-asset decisions. If this is not your cup of tea, then look at a one-in-all solution like Sphere, which can solve all of these decisions for you with one investment. So going forward, let's look at the first and obvious asset class, which is fixed income. So when we look at lower interest rates, I think the important thing to recognize is that the RBI has been preemptive and has front-loaded their interest rate cuts. So in 2025 alone, we've had a 1% cut in the repo rate. So we've gone from 6.5%, which is where we were at the start of the year, to 5.5%, which is where we are in June. So this 1% cut happened over 3 sessions. So February was the first cut, that was 0.25%. Then you had another cut in April, which was 0.25% again, and a stance shift from neutral to accommodative. Then in June, we had a mega cut of 0.5%. And another stance shift from accommodative to neutral. So the way that we are right now shows that we're more in neutral territory, meaning we're not really expecting more rate cuts to come in, but we could also see it depending on how the global context evolves. So when we're looking at an asset class like fixed income, when interest rates move down, bond prices move up, and in that context, it makes sense to take duration risk. But if we see where we're positioned in the cycle today, we've already had a few cuts, and some of those cuts have been partially or fully transmitted into the system. So where you enter your duration call makes a lot of a difference, and whether that's a risk an investor wants to take today or not is something that they need to decide for themselves, because when you have duration risk in the portfolio and it happens at the wrong time in the cycle, you could end up with a negative return. So the key idea is to lower your expectations, whether it's with fixed income or any other asset class, because then you can also lower your risk levels in the product choices that you're making, and that will ensure that you're positioned correctly to capture this difficult environment. Now, moving on to equities, normally lower interest rates are considered a very good thing for equities, primarily because cost of borrowing comes down, companies can leverage, and then you would see a spurt of growth from that direction. But if we look at where we've been in terms of valuations, we've talked extensively about how valuations are actually quite stretched, and there is a need for investors to be very cognizant of how much money they're putting in or what the valuation is of the businesses that they own. So previously, a top-down approach to equity investing worked. So you could look at some macroeconomic trend and then try to assess which sectors would benefit from that. Whereas the market context that we are in today involves a more bottom-up approach, which means you're going to look at things at the micro level. You're going to evaluate companies based on their merit, their ability to withstand cycles and shock, as well as their corporate governance standards and their growth prospects. So the mindset shift from top down to bottom up really needs to happen as far as equity investing is concerned. Then we move on to our precious metals basket, and the broad idea here is that in the global macroeconomic context, allocation to precious metals actually makes a lot of sense. There's a lot of global macro risks if you think about it, whether you're looking at elevated debt levels across different economies, if you're looking at the global slowdown, or even if you look at how central banks have been prioritizing shoring up their balance sheets in terms of buying gold, or industrial demand when it comes to silver. So there are many macro trends which are actually in favor of having precious metal allocations. But again, as with everything else, this moves in cycles. So it's important to look at how to allocate, when to allocate, and what the risk is when you make an allocation decision. Lastly, we come to the global component of a multi-asset portfolio, and there are a lot of big shifts that are happening across the globe, whether you're looking at the US, China, Japan, or Europe. There's a lot of news that's coming in from each of these economies, and their individual challenges are quite different from one another. So in this context, I think there is a lot that's on your plate. There is very limited visibility, And it makes sense for investors to keep an eye on what's developing on the global front, because there could be many interesting opportunities that come up. But given where we are today with the level of uncertainty and the direction of valuations, it may make sense to take a step back and then watch and see what's unfolding before you take a big step or a decision as to where you need to allocate your capital. So before we close this video, I want to leave you with 3 things that you can do today. The first is to lower your expectations as far as returns are concerned. The context has changed quite a bit. It's become a lot more difficult for you to invest. And so if we lower our return expectations, we'll end up making better choices in terms of protecting our assets. The second point that I would like to leave you with is to look at a more continuous participation approach to investing today. The basic idea being that the context is changing gradually and continuously, right? So there are a lot of changes that are occurring. There are going to be more opportunities that come up. We are in a cyclical phase where risks are slightly elevated. So staggering your investments rather than stopping them is the way to go forward. So if you're able to take a more continuous and gradual approach to investing, whether that's in the form of systematic investments or continuous contributions through the next 18 months, then you're likely to emerge as a winner through this difficult phase of investing. The last thing that I would encourage every investor to do is to think afresh. We've had a stellar time in the markets until 2024. 2025 has actually challenged many investors quite a bit, and it makes sense to start thinking about things afresh. So whether it's your overall asset allocation, whether it's individual companies in your portfolio, there is a need for you to go back to the drawing table and see what works in this context and make sure that you're in the right place at the right time. With that, I wish you a very successful investing journey. If you'd like more updates like this, please subscribe to our channel and tune in to the next episode of Into the Multiverse with Sphere.